Good afternoon, everybody. Scott Riley, the market update desk with Scott Riley, NMLS 157524. Got a busy set of information to go over today as we weren't able to do anything yesterday. And today starts the MLB playoffs. Surprisingly, the Tigers got in. Let's see how scrappy they can be and if they can put a little pressure on Cleveland this afternoon. So, the main event for the week is the potential and probable government shutdown. A lot of what's going to happen is going to depend on the length of the shutdown. The market's already indicating that they're expecting the shutdown. Now, yesterday, we saw Cleveland Fed President Beth Hammack spoke and was once again, I should say, very hawkish. She's not a voting member this year, but she's going to be next year. So her comments are important so we can start to get a track of where she's going to be voting in the future. So Hammack said that the labor markets were still doing okay. I'm not sure her definition of okay, but mainly because of the VU ratio. Now, the reason that's coming into play is that's the ratio of unemployed people to job openings. Now, that's near a 1-to-1 ratio. Where in the past, during the COVID timeframe, it was almost a 1-to-2 ratio. So it's very important to follow that. It means that there's really one job opening for every person now. So it's starting to release some pressure on wage inflation. Now, in her commentary, she does not mention the trajectory of where that's going. As we talked about, it was near 2-to-1 and now down to 1-to-1. So that's a downward direction versus what I would call healthy. Additionally, the job openings that she's citing are very likely overstated because of the work from home nature that we're in now, because they count jobs at state level. One job could be posted in multiple different states. So it's hard to track really how many jobs are out there, and that's why it's likely overstated. She's clearly focused on inflation more than the employment side of the dual mandate, thinks it's too high, but does not give any nod to the impact of tariffs or overstatement from the shelter component that's in all these inflation readings. Now, Truflation came out today. That's a much more widespread data analysis than what the BLS gives on inflation. And it gives it in real time versus rear looking. And they reduced their reading from 2.2 to 2%. So that's a good sign. Yesterday, we also had Fed Governor Bowman speak on Friday, brought up the possibility of utilizing Operation Twist. We've had that before. We used that back in 2011 and 12. That's where the Fed sold shorter dated maturity treasuries and bought longer dated ones without changing the size of their balance sheet. So that did help because the balance sheet's very important. Now, this helped keep mortgage rates lower. She also indicated she was not in favor of the Fed holding mortgage-backed securities on their balance sheet, and even mentioned a potential for selling them. That's not a good sign or indication for mortgage rates. She's also in favor of the recent Genius Act. This is the regulatory bill on stablecoins. She believes that because of most of what they own peg themselves to the dollar in treasuries, it could be a good source of demand for the treasuries that we need to sell and help bring longer term rates down, meaning mortgage rates also. She'd also like to see bank deregulation deals passed where the big banks could buy more treasuries without impacting their supplemental leverage ratio so that they could purchase more treasuries and again help the supply that we've got to sell. Now, today we've got the JOLTS report that we're going to review. Tomorrow we're going to get ADP, mortgage applications, Thursday jobless claims, and then Friday it's supposed to have the BLS jobs report, but likely not going to get it. So the government shutdown is going to likely affect the BLS on their jobs report. That's going to make the ADP employment report that's going to be released tomorrow very, very important, and more weight than what it normally brings. So it'll be the de facto jobs report. Helping bonds so far this morning are the weak consumer confidence report numbers, which fell from 97.8 to 94.2. So within that report, we saw 26.9% of consumers said jobs were plentiful. That was down from 30.2%. 19.1% said consumers said jobs were hard to get. That was unchanged from the previous report. And 16.1% of consumers expected more jobs to be available. That was down 17.9%, that previous report. 25.6% anticipated fewer jobs, down slightly from the 25.9 in the previous report. On the plus side, plans to purchase homes for consumers rose. That's what we've been talking about. Get out there now to a 4-month high. Boston Fed President Susan Collins, who's a voting member, spoke this morning on CNBC, and it sounded like she would be in favor of at least one more rate cut this year. I think the market's really trying to figure out, are we going to get that third rate cut? And that's why we have some stalling in the 10-year Treasury to an extent. Underscoring the weakness in the labor market was the JOLTS report today, Job Opening and Labor Turnover Survey report. That showed job openings were little changed at 7.2 million, which was near estimates and at very, very weak levels. There were almost 200,000 more job openings in healthcare, social assistance, and leisure and hospitality. That means many of the other job sectors saw drops in opening. And health, social service assistance, leisure, hospitality were the sectors where most of the job growth has come from within the jobs report. Over the last 6 months, if you remove those sectors and look at what would be the core jobs, we've only seen an increase of 0.002, basically zero, from all other sectors. Historically, when the core jobs growth as a percentage over the last 6 months comes close to zero, it is the precedent of a recession. So we've got to watch that carefully. Hiring rate set a recent low, falling from 3.3 to 3.2%, lowest level since 13 when you remove out COVID. And the quits rate, that also set a recent low, went from 2% to 1.9%, lowest since 14 when you take out the COVID timeframe. The most recent pending home sales report came in as a positive, showed that the drop in rates in August that we saw generated more activity. So sales were up 4% month over month, which beat estimates, which was looking for a flat reading. Now this, and year over year, we're up 3.8%. Obviously it depends on the market you're in, but here in West Michigan, probably even more than that. This goes in line of what we saw with the new home sales report, which showed about a 20% spike. Now, on the technical side, mortgage bonds are moving to the higher side this morning after we got this weaker jobs report. The JOLTS report, and they're looking to try to break above their 25-day moving average. If the break is confirmed and we have a weak ADP report, got almost 40 basis points to the upside where rates could improve. On the opposite side, 10-year Treasury, we've broken back beneath the 25-day moving average, and we're again bouncing off that 4.125, 4.126 marker. If we get some weakness in the ADP tomorrow, the next stop's 4%, but we've had speed bumps before trying to get down to that. So tomorrow's going to be very important for the week, and obviously we'll know more on the almost guaranteed government shutdown tomorrow. Give us a call. We just had we were working last night in the Cabana office, probably till 10:30, working on numbers for borrowers that were looking to write offers in, talking with our realtor partners, sending out loan application documents. So, yep, we work around the clock. Give us a call, 616-293-2189. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. Go Tigers.